Good afternoon, everyone. On behalf of the Sustainability Reporting Standards Board of I, CA Tanushri Patil, extend a warm welcome to all of you to the 37th session of our webinar series, Demystifying Sustainability, Catalyzing Growth. Today's session is centered around a critical theme, decoding SEBI's Master Circular on ESG rating providers. I would like to introduce our esteemed speaker, Ms. Ruchi Singh. Ma'am, welcome. I will give a short uh, brief of our esteemed speaker. A detail-oriented legal, compliance, and sustainability professional with strong expertise in ESG regulations across the Middle East and India, supported by a solid corporate law and secretarial background. The professional specializes in integrating ESG principles into governance frameworks, compliance systems, and sustainability disclosure, including BRSR and BRSR core reporting. With experience in sustainability audit, legal drafting, data analysis, and regulatory advisory, the profile reflects a comprehensive understanding of regional and international sustainability standards. Skilled in monitoring and analyzing key sustainability KPIs, evaluating performance trends, and guiding organization in strengthening ESG control, risk mitigation measures, and responsible business practices. Known for clear communication, stakeholder alignment, and sound ethical judgment, the professional contributes to elevating governance maturity and enhancing organizational sustainability. The academic background of our speaker includes company secretary along with gold medals in LLM, corporate law, and BBA LLB. We welcome you, ma'am. I hand over the webinars to you, ma'am. Welcome, Ruchi, ma'am.
Thank you so much, Tanushri, for a great introduction. I'm grateful, and hello to each and everyone joining this webinar with us regarding the sustainability and ESG. So, as we all know, in today's day and time, we have BRSR and ESG raging globally, and not only in India but all over the world. The investors are seeking the ESG parameters or the BRSR reporting when we talk about India. So, before diving into the master circular issued by SEBI with regard to the ESG rating providers, let us first start what is ESG all about, how we proceeded with the ESG factor to BRSR, and how the ESG rating providers came into picture, and what is ESG rating in the very first place. So, why was there a requirement to have a master circular for the ESG rating providers, where the ESG rating providers were already covered in the credit rating regulations already instituted by the SEBI. So, first of all, let us start with the ESG. ESG, as in the name itself, incorporates the aspects of environmental, social, and governance part of any organization. So, earlier and till today in India, in when we talk about the private companies, we only focus on the financial parts. We are not focusing on what the company holds in terms of environment, or in terms of social or society, or in terms of governance. So when we start with the ESG aspect, India incorporated BRR at the very first place, and then the BRR concept was changed, or let's say, we should say in more appropriate words, it was moved toward the BRSR, that is a business responsibility and sustainability reporting. So right now I'm going to share my screen, and let's dive into what BRSR is all about. So for today's agenda, we have with us the BRSR reporting, ESG credit rating, and SEBI's master circular for ESG rating providers, which is now given by SEBI in the year 2025 itself. And then we can have the questions. So, the BRSR structure, as I earlier mentioned, that BRR was the first initial step where SEBI introduced guideline reporting for us. So the structure started with the BRR, and now it has been now converted into BRSR. Now the BRSR only mandatorily applies to the listed entities, top 1,000 listed entities in India. Now, new BRSR format has now qualitative as well as quantitative aspects. The BRSR format, when we see, which is issued by the SEBI, contains 9 principles, and each 9 principle has been carefully curated with the essential indicators and the leadership indicators. So, when it comes to the essential indicators, it is mandatory for all the reporting entities to report on each and every question mentioned in the essential indicators. And when it comes to leadership indicators, it is, of course, a play area for each reporting entity where they can showcase their leadership skills in their sector, in their industry, wherever they are reporting about the ESG aspects. Now, this annexure, which the SEBI provided, or the format provided by the SEBI for BRSR, also have a guidance note where if any reporting entity has any confusion or any questions with regard how to a particular information is to be reported, they can refer to the guidance note. Now, entities already preparing and disclosing sustainability reports based on internationally accepted reporting frameworks. That was the earlier scenario when SEBI did not had the BRSR format. But now in India we have our own BRSR format and we can follow it. We now also have the BRSR core reporting where the most core aspects, the key performance indicators are reported in the BRSR core, and that data is assured, that is audited by a separate agency, which gives you the assurance that whatever data is reported in the BRSR report is completely legit. The MCA constituted committee's report mentions that MCA may extend requirement to unlisted companies above specified thresholds of turnover or paid up capital. Committee also recommends that the smaller unlisted companies below the above threshold may adopt a little version of the format on a voluntary basis. So there are many companies who are also adopting the BRSR reporting on a voluntary basis, and they are doing it so not only in terms of letter, but they are also doing it in the terms of spirit. So the earlier timeline for adoption was with effect from the financial year 22-23, where filing of BRSR was mandatory on top 1,000 listed entities by market capitalization. As I already discussed, that we have 9 principles in the BRSR annexure or the format introduced by the SEBI. We also have Section A and Section B. The Section A gives you the background, the glimpse, the introduction of the organization, what it does, how the reporting is going to be, whether the entity is involved into the CSR aspects or not, what is the turnover, from where they are getting their maximum turnover, their associates, their subsidiaries. So basically, Section A is a general disclosure section where the basic information of the company is disclosed to all the readers and investors. Coming on to the Section B, this is management and process disclosures. Now, a level deep insight is given to all the readers and investors that contains disclosures with regard to the policies and the management processes. It answers the queries of the investors that whether the policies formulated by the board of the company is actually taken into and incorporated into the processes of the company. What is the compliances going on? How the governance takes place? What is the director's take on the ESG aspect? What are the goals set by the company with regard to the ESG aspects, and whether those goals are met or not? So, this is a very broad section B which deals with the management processes and policies and gives you an oversight over the leadership practices of the organization. Coming on to section 6, which contains 1 to 9 principles. These principles deal with various aspects and covers the three aspects, that is the environmental, social, and governance aspect of a company. Principle 1, it deals with the ethical and accountability practices of the company. It says business should conduct and govern themselves with integrity and in a manner that is ethical, transparent, and accountable. Principle 2, businesses should provide goods and services in a manner that is sustainable and safe. And principle 3 deals with that we need to promote the well-beings of the employees. So as we can see that we are moving from the social and governance aspects not only the financial aspects, but we are also focusing on to the social and governance aspects of an organization. Principle 4 deals with the interest of and be responsible to all the stakeholders. Principle 4 deeply connects and gives you a highlight of all the stakeholders of the organization, how the organization communicates with those stakeholders. It also provides an insight that whether those stakeholders are a part of vulnerable or marginalized group or not. Coming on to principle 5, businesses should respect and promote human rights. It also contains questions that whether the company is providing trainings to its employees on human rights or not. It contains and asks whether the company has policies with equal opportunity policies for all the persons, whether they are disabled or not. So these principles have been curated so that the social aspect is completely taken into picture and reported to the investors. Coming on to the principle 6, which is a technical aspect, covers the technical aspect of the organization, and it deals with the energy consumption, water level consumption, wastage done by the entity, and how the waste management is done by the entity. So, Principle 6 says business should respect and make efforts to protect and restore the environment. This principle covers the environmental aspect of the organization. Principle 7 says business, when engaging in an influencing public and regulatory policy, should do so in a manner that is responsible and transparent. Principle 8 says businesses should promote inclusive growth and equitable development. It talks about CSR. It talks about whether the company is mandatorily required to do CSR, and if yes, then who are the beneficiaries? What is the percentage of beneficiaries? Who all are the persons who are getting the benefits of the CSR activities done by the individual, by the entity? Principle 9 at last covers the businesses should engage with and provide value to their consumers in a responsible manner. This principle highlights that whether the entity is reporting to its customers how to use their products, how safe their products are, what are the channels of communication with the customers, whether the company is handling the grievances of the customers or not correctly. They ask about the approaches and the internal mechanism of a company, how to deal with the grievances of the consumers and other stakeholders. So, in all, BRSR reporting covers all the three aspects: environmental, social, and governance aspects. Now, being said that, BRSR has been reported in India now for now quite few years, and there was a need for the assurance that uh, in order to confirm that greenwashing is not done, that the data provided is not manipulated. So we had few challenges, as I am discussing, that we had few challenges while reporting the BRSR data. So the data collection was one of the major challenges. Without data, you cannot report about an entity. So many follow-ups were required. The capturing of data was not correct. It was a time taking process. Now, all the departments were required to be involved. Also, being a very new process and introduced newly to the employees of an entity, it was a bigger challenge to collect data, and not only the data, but it should be the correct data. Now, you have to set the expectations, the benchmarking practices of a company, initiatives, action plans. What will be the key performance indicators? How we are going to report them, how a particular reporting entity will lead in its industry or in the sectors, how the BRSR report will set the expectations of its stakeholders. Because whatever is reported in the BRSR, it at the end forms a part of the annual report. Annual report is a public document, and now the BRSR is definitely becomes a public document. So it is not only the investors or the stakeholders who are going to get an insight of the ESG aspect of the reporting entity. It's everyone, it's each and every person who can look into the organization, what is going on in the organization apart from the finance, how the organization is taking care of its employees, how the organization is interacting with its customers, how the organization is taking steps to save the environment in which it is operating, and the like things. So, the other challenge we face while doing a BRSR reporting is one way. communication. There is a delay in the departmental interactions. So there is a lot of delay because the data is interrelated, and the departments sometimes get delayed because of their interdependencies, and it becomes a significant challenge in the data collection process. As I earlier also mentioned, that it is not only what we have to collect is the data. We have to collect the data correctly. That the data reported is correct and it's not manipulated. So data validation here becomes an important step. We need to see that the data reported in the BRSR report is consistent. There are no huge deviations, which puts a question mark on the reporting entity, that creates a question or creates a gap, that how this data can have such a deviation. So those errors are also to be flagged and to be seen, and the corrections are required to be made, that whether that the data collected and given by the departments is not incorrect, it should be correct. Language expectations. Expectation on the language and narrative is to be set in advance with all the stakeholders, with all the departments, that how we are going to report in our BRSR report. Ownership for proofreading, of course, it is a very lengthy report, and we all are humans and we can make mistakes. So, of course, it takes proofreading, a lot of proofreading, a lot of data is there, a lot of qualitative answers are there. And while reporting, whenever you skip a word, you might want to say something positive and it might convert into something which is negative, which is harmful, and which also hampers the reputation of the organization. Coming on to the next challenge is non clarity on leadership indicators. Leadership indicators, as I earlier mentioned, are the optional questions which are to be answered by the reporting entity. And there are times when entities get confused how they are to be reported. Now, we had a brief introduction what BRSR is all about, how the BRSR annexure came into picture, and what are the points we are, or the information which you are giving in the whole BRSR format. Now, the companies are doing the BRSR reporting and the sustainability reporting along with other things. Now, there is a concept which is known as ESG credit, ESG rating. What is the purpose of this rating? Why we need these credit ratings? Why we all must have listened or heard that there is while giving loans we have credit ratings, you have your CIBIL score, and these all ratings help you to have a loan. In the same way, the banks are not only focused on the CIBIL score of the entity, they are also focused on the ESG rating, that how the entity is performing in terms of the environmental, social, and governance aspects. They focus that what is their relationship with the stakeholders. The investors are invested to know that whether this company has the sustainability which will make it grow further in longer run. So ESG rating is now something which everyone wants to know, that whether this reporting entity, or let's say the organization, have such sustainability or such environmental actions into place which attracts the investors towards it. Moving on to the ESG ratings. So, ESG ratings, environmental, social, and governance ratings, have emerged as a globally recognized benchmark for assessing corporate sustainability and ethical performance. Much like credit ratings measure financial creditworthiness, ESG ratings evaluate a company's resilience to long term non financial risk and opportunities. ESG ratings have various factors, and various factors are measured, and that's how they are rated. They are rated on different aspects of E, S, and G. How the reporting entity is doing on those aspects. It is measured and it is critically measured. Firms with strong ESG ratings, of course, they get the reputational advantage. They get greater investor confidence. ESG rating, not only in India but is globally sought by the investors to make decisions, to make investment decisions, that whether a person should invest in a particular entity or an organization or not. Global and Indian context, when we discuss globally, ESG focused assets are projected around $50 trillion by 2025, representing more than one third of total assets under management. The COVID 19 pandemic further accelerated the adoption of sustainable investment strategies, reinforcing the view that strong ESG practices enhance business resilience. In India, the ESG ecosystem has shaped not just by investors but also by regulatory mandates, stock exchanges, and global supply chain expectations. Indian corporates face increasing pressure from international buyers and lenders to demonstrate credible ESG credentials. So, when we are doing exports and imports, companies require the ESG rating. The international buyers and lenders are asking for the ESG rating, and that's why ESG rating is so important in the Indian context as well. This momentum has been reinforced through mandatory sustainability disclosures such as BRSR framework, the growth of ESG themed investment funds, and rising demand from institutional and retail investors. As I earlier mentioned, that ESG rating is required by the investors to make the investment decision that whether this company is sustainable, that whether the ESG aspects are properly covered and incorporated into the process of the organization or not. So, because of the ESG ratings and the demand that a company must have ESG rating, the concept of ESG rating providers was came into picture, and therefore the need arose that we need to regulate these ESG rating providers, the ERPs. So, the regulatory approach. Uh, The SEBI regulatory approach. The SEBI Credit Rating Agency Regulations 1999 to bring ESG rating providers under formal supervisory framework. So CRA already existed and it broadly covered the ERPs, the ESG rating providers. This transition from voluntary practices to enforced regulation ensures that ESG ratings are now treated with same level of scrutiny and credibility as credit ratings. Since the investors are uh, taking investment decisions based on the ESG ratings, it became pertinent to have the ERP regulated and the ratings given by them come under scrutiny of SEBI. Importantly, SEBI has also mandated that ERPs disclose their rating methodologies in a manner that allows comparability across industries and sectors, addressing earlier concerns of opacity. So, without regulation, if a ERP is giving ESG rating to any organization, you don't know how the rating came on, let's say, on a scale of 0 to 100, how the rating came to be 80 or 75. What were the factors considered by the ERP? What were the methodologies used by the ERP? How the data was collected by the ERPs and how the data was validated by the ERPs. Therefore, regulation was required. So there is two-tier ERP system. The ERPs itself are divided into two categories, category 1 and category 2. Category 1 ERPs are the larger players must maintain high capital governance thresholds, while category 2 ERPs are smaller ones, operate under lighter requirements to encourage entry and innovation. So category 1 ERPs are those ERPs who can also give the green securities credit ratings, whereas category 2 ERPs are not allowed to do so. They are only allowed to give the ESG rating. Also, the net worth of category 2 ERPs to be maintained is in lakhs as compared to category 1 ERPs whose net worth to be maintained at all times is in crores. When it comes to the number of employees, that category 1 ERPs is obviously higher than the number of employees to be maintained by category 2 ERP. ESG rating classification. Now, also the ratings provided by them are also classified impact ratings and risk ratings. In the master circular, which we are going to discuss in a very soon, there the ratings are distinguished between impact ratings and the risk ratings and requires full transparency in methodology, weightages, and assumptions. The introduction of a core ESG rating based exclusively on assured BRSR core data ensures that sustainability scores are linked to independently verified disclosures rather than voluntary self reporting. So, as we discussed, that BRSR is something which the entities report on their own. The data reported in the BRSR report is a self-reported data by the entity, whereas BRSR core has the KPIs in which the data provided by the entity is assured by a third party. So that BRSR core data, when taken as the support or the baseline to provide the ESG rating, it becomes core ESG ratings, and it is exclusively based on the BRSR core data, which therefore ensure that the data provided by the reporting entity is not something which they are reporting on a voluntary basis, but it is the data which has already been verified by an independent assessor. Governance, oversight, and IFSC extension. ERPs are now subject to governance requirements such as forming ESG rating committees, nomination and remuneration committees, and conducting annual internal audits. Category 2 ERPs have been granted a 2-year compliance buffer, while larger category 1 ERPs must comply immediately. SEBI also requires operational separation of rating and consulting businesses to eliminate conflict of interest. Additionally, ERPs must now maintain minimum professional staffing and technological systems to ensure data integrity. To extend credibility globally, a July 2024 circular was allowed. So that was the circular which first came into the picture, and now the circular which we are going to discuss is July 2025 circular, which has now consolidated and superseded all the earlier master circulars introduced by the SEBI. Implications and market impact. The regulatory framework consolidated through SEBI's master circular of May 2024 and subsequent updates institutionalizes transparency, accountability, and consistency in ESG ratings. So, as we earlier discussed, that ESG rating is very prominent in today's day, and the providers are also required to be regularized and regulated by any external agency. So, for us, we have SEBI, and under the SEBI, we have CRA, credit rating regulations, under which the ERPs are covered. A master circular has been published by SEBI in July 2025, which deals with all the ERPs, how they are to be registered, what will be the procedures for transfer, for cancellation, for suspension, how will they be audited, how they are going to report or give disclosures on a continuous basis, and other such parameters are given under the master circular to regulate the ERPs. So as we can see that this is a snapshot of the SEBI website where we can see the ESG rating providers. Now ESG rating providers have two models on which they can perform or on which they can work. One is the issuer pay model and other is the subscriber pay model. Now issuer pay model, as the name is itself suggesting, that the issuer of the securities or any organization is paying the ESG rating provider. So the revenue comes from the issuers. And subscriber pay model is something which generates revenue through investors. Investors are asking the ERPs to provide ESG ratings so they can make the investment decisions. So, as we can see, Beacon ESG Ratings and Research Private Limited is one ERP which has issuer pay model. Care ESG Ratings Limited is another ERP which focuses on the issuer pay model. Now, CFC Finlease Private Limited is a ERP which works on the subscriber pay models. Now, these models have different regulations, have different disclosure compliances as provided in the master circular data. So, for issuer pay model, when ERP is operating on an issuer pay model, it has to have an agreement with the issuer to which it is going to provide the ESG rating. In that agreement, they cover all the major aspects, that how the data will be provided, what will be the compensation for the ESG rating, and such other aspects. Importance of ESG ratings for companies and investors. So, why, as we already have discussed, that why ESG ratings are required? What is the importance of ESG ratings? ESG ratings, access to capital market and market opportunities. ESG ratings have emerged as a decisive factor. As we already talked about, that how the investors are focusing to have ESG rating to make their informed investment decisions. So ESG ratings help the investors to take their decision of investment. It gives a brand value to the company. Higher the ESG rating, higher the reputation of an organization. ESG ratings serve as an independent validation of corporate responsibilities. Higher rating strengthens the reputation, enhance brand value, and can be even be leveraged in marketing as a competitive differentiator. Companies that invest in renewable energy, community welfare, or diversity initiatives often highlight their ESG scores to reinforce stakeholder confidence. So now, running an organization is not only about the numbers or the financials or showing how much revenue can be generated by an organization. Now the organization also needs to report how it is treating its employees, how it is treating its environment, how the organization is contributing to the society or to the area in which it is operating. So this gives you a brand value, a reputation, and it also helps you to gain the trust of the stakeholders. Regulatory compliance, risk mitigation, strategic alignment. For sure, since the SEBI has mandatorily provided us with the BRSR format and it is applicable on top 1000 listed entities, so definitely it comes with the regulatory compliances. But for the organizations who are doing the BRSR exercise on a voluntary basis, it gives them a higher brand value or a higher reputation when compared with other organizations. It is beyond financial and reputational benefits. ESG ratings are increasingly linked to regulatory risk management. Because ESG ratings, when given, also cover the part where it discloses that what is the how much a company is exposed to the risk related to the ESG aspect. Higher environmental scores indicate compliance with pollution control, climate disclosure, and other statutory norms, reducing the likelihood of penalties or shutdowns. So when the ESG rating is provided, it will definitely highlight the environmental score. So the environmental score will help the investor or any other person or the stakeholder of an organization to know that what is the degree of risk the company is being exposed to in terms of environmental aspect. So if the score for the environmental aspect is high, that means it shows that the company has been compliant with the environmental laws, it has been compliant with the statutory norms, and it is reducing the likelihood of penalties and shutdowns. Similarly, robust governance scores imply safeguard against fraud, SEBI enforcement actions, or accounting irregularities. So, ESG rating, it covers all the three aspects: environmental, social, and governance aspects. It rates on those aspects, and that's how the company, the company, and that's how the company shares its image. Investor decision making and benchmarking. For investors, ESG ratings provide a structured framework to incorporate sustainability into portfolio strategies. They enable negative screening, positive screening, and integration. With the rapid growth of ESG funds in India, launched by major AMCs like SBI, HDFC, ICICI, ratings are now central to fund construction and rebalancing decisions. Inclusion of benchmarks such as the Nifty 100 ESG Index or S&P BSE 100 ESG Index is contingent on strong ESG ratings, directly impacting a stock's visibility, liquidity, and investor base. Now, here are the few case studies through which we can see that how ESG ratings are impacting an organization. So, if we take the example of Reliance Limited, so it has positive impact of the ESG rating. ESG improvement supported global capital raising and long-term investor appeal. So the detail of this case is Reliance Industries have made a notable strides in renewable energy, circular economy initiatives, and transparent disclosures, resulting in improved ESG scores by MSCI and Sustainalytics. These efforts have enhanced its eligibility for global sustainability linked financing. So, as we can see that with a good ESG rating, Reliance is able to have its foothold in the sustainability linked financing market. High ESG visibility has supported its strategy of raising green bonds and tapping ESG sensitive capital pools, aligning its transition narrative with investor preferences. We can take the example of Vedanta Limited. Vedanta Limited had the impact of ESG rating, which is negative. Now, the controversies reduced the ESG ratings, which triggered investor concerns. So, when the ESG rating is negative, it also hampers the reputation of the organization. Vedanta has often faced governance and environmental controversies, leading to weak ESG ratings relative to peers. While not a sudden scandal, ESG raters consistently flag risk around environmental compliance and social licenses in sensitive areas. These downgrades have contributed to negative investor sentiment, limited ESG fund participation, and reputational constraints, underscoring how low ratings translate to higher cost of capital and constrained access to responsible finance. As we were discussing, that ESG ratings, when given on a higher side, they tell you that how much the company is compliant with the environmental compliances or the social compliances or the governance compliances. But when that ESG rating is less or low, it also shows and it enables the investor to have knowledge that the company is having the compliance issues with regard to the ESG aspects. So, in the case of Vedanta, when they have controversies around environmental aspect or the governance aspect, it leads to investor concerns. Another case which we can see is Tata Steel, which again has a positive impact. Improved ESG scores attracted ESG conscious investors and aligned with global decarbonization goals. Tata Steel has steadily improved ESG ratings by enhancing disclosures, focusing on circular economy initiatives, and committing to net zero by 2045. ESG raters like Sustainalytics marked improvements in environmental management and governance. This bolstered its credibility, attracted long term ESG funds, and improved international competitiveness, particularly in European markets with strict carbon border adjustment mechanism. So the Tata Steel has a positive impact of the ESG rating. It attracted long-term ESG funds and improved international competitiveness. So as we can see that there are so many cases or the controversies which happen all over India and of course globally. But the impact ESG rating has on these organizations can be both positive and negative. Sometimes it help you to enter into a new segment, into a new market of capital funds, and sometimes it create concerns for the investors, for the stakeholders, and also hampers the reputation of the organization. In the case of Hindustan Unilever Limited, strong ESG profile, enhanced valuation and investor preference. While investing, the investor is now not only looking into the revenues, it is also looking into the ESG aspects. Sustainability is something which, while incorporating at an early stage in an organization, may seem costly to the organization, but in the long run, it helps you to gain the trust of the stakeholders, to gain the trust of the investors. And also, day by day, the government is also focusing onto the ESG aspect, onto the sustainability, how the organization can make the environmental safer or can align itself and its processes with the SDGs, that is the Sustainability Development Goals, the UN SDGs. As in the case of Tata Steel, we see that they are committing to net zero by 2045. Now, coming on to the core topic of today's webinar, that is SEBI Master Circular for ESG rating providers. Now, when looking into and understanding the concept of ESG rating and its importance in today's day, there is high demand, and not only the demand, it is pertinent and it is required to have a framework, a regulatory framework for ESG rating providers. Many master circulars were provided by the SEBI, and now to remove all the difficulties, all the confusion, SEBI Master Circular for ESG rating providers in July 2025 came out, and it superseded all the previous master circulars. Now it has consolidated all the previous circulars. Now, SEBI Master Circulars covers the entire regulatory framework. It includes registration, governance, rating methodology, the disclosures, how the audit is to be done, what will be the medium or let's say the module on which the ERPs are going to work, whether they'll work on the issuer pay model or subscriber pay model. Applicable to all entities registered as ERPs under amended CRA regulations. So we'll also see the process how ERPs are registered, what is the registration mechanism, and how the ratings are provided by the ESG rating providers, what are the disclosures to be made, how their licenses or their certifications are surrendered or suspended. So let's see the SEBI Master Circular. So today's agenda, we are going to look into the depths of the SEBI Master Circular: registration, change in control, surrender conditions, rating operations, rating rationale, how to avoid conflict of interest between the analyst, the employees of the ERP, the business separation, the trading restrictions, mandatory disclosures, reporting formats, how the internal audit will be done for ERPs, how the board of ERPs, the board of directors of ERPs are going to oversight the requirements and the compliances with these master circulars and regulations provided by SEBI, how the industry classification will be there, what are the aspects or the work which can be outsourced by ERP, what are the implications for professionals, issuers, assurance providers, and investors. So the master circular by provided by SEBI in the year 2025 contains majorly five chapters. So the first chapter deals with the registration aspect. The second chapter deals with the rating aspect. The third chapter deals with the reporting and disclosures. The fourth chapter deals with the internal audit for ERPs, and the fifth is the miscellaneous chapter. So now, in all these chapters, out of all these chapters, chapter number two, that is rating operations, is the most detailed one. It gives you deep insight of what are the type of ESG ratings, what are the scores provided, what is the rating scale, what are the other activities which can be undertaken by the ESG rating providers, what are the business models, how the rating is given, what are the rating methodologies, what is the rating rationale behind giving a particular rating to an organization, when and how can the ratings given, the ESG rating given by an ERP can be withdrawn, what request by issuers for review and appeal against an ESG rating provided to them, the governance norms of ERPs, accountability of rating analysts, dealing with conflict of interest, guidelines on listed securities in instruments, and the like. So we'll first start with the chapter number one that deals with the registration, approval, and surrender requirements. So ERP is already regulated under the CRA regulations, and this master circular provided by the SEBI further deals with the procedures and the aspects that how registration mechanism is to be followed by an ERP. So, as we all know, that SEBI is the organization which is regulating these ERPs. So, definitely, SEBI is the only organization under whom the ERPs are going to be registered. So, for registration, they have to file a form along with a non-refundable fees. So the fees is non-refundable, and while filing the form, the ERPs are required to mention that whether they are registering under ERP category 1 or ERP category 2. They're also required to mention that what will be the business model for them, whether they are going to work on issuer pay model or they are going to work on to the subscriber pay model. So, SEBI has a portal, that is SEBI intermediary portal, through which they can file their applications. But till the time this portal comes into operation, the filing has to be done through a mail ID, and all the documents relating to the firm and to this registration are to be submitted through that mail ID. And physical forms and records are also to be submitted apart from this online filing process. All applications for registration, surrender, or any other request will be made through SEBI intermediary portal. The applicants will be separately required to submit relevant documents, namely declarations, undertakings, required as a part of the application form in physical form for records without impacting the online procedure. However, till the operationalization of SEBI intermediary portal for ERPs, an entity desirous of registering with SEBI as an ESG rating provider may file an application with SEBI under the CRA regulations, along with, as I earlier mentioned, the non refundable fees and relevant documents in hard copy, which is addressed to the Chief General Manager, Department of Debt and Hybrid Securities, SEBI. Now, once the application has been filed by the desirous ERP organization, there will be the grant of certificate by SEBI. SEBI can also say no to get an organization being registered as an ERP. So now come the next part, which is grant of prior approval for change in control of ERPs. Now, when an organization is already registered as an ERP, and now the control of that ERP is going to change, then how the SEBI requirements or disclosures or compliances come into picture. So for being an ERP, you need to be registered uh, under the Act, Companies Act. So now, for let's say, company X is now going to have its control taken over by another company, company Y. So what will be the procedure? How the control change will take place? So, as per regulations of CRA, all registered ERPs are required to obtain a prior approval by the SEBI whenever there is a change in control. Now, change in control can only can take place directly, or it might require the NCLT approval also. So, to streamline the process of providing approval to the proposed change in control, the following things are to be taken care of by the ERP. So ERP will first again have to make an application to the SEBI and through the SEBI intermediary portal. And while the portal is not in operation, it has to be made through email via soft copy as well as hard copy. The application by an ERP shall be accompanied by the information. So, what are the information to be given along with the application? What is my current shareholding pattern? What will be my post control change shareholding pattern? Whether any application was made to the SEBI in past seeking the registration but it was not granted, whether any action has been initiated under the SEBI regulations or the SEBI Act or the SECRA Act, or whether any corrective actions were taken under to avoid such situations in the future, whether any investor complaint is pending with the ERP. If yes, what are the steps taken? How you will resolve the grievance of that investor? Details of any litigation which is pending against the ERP. You also have to give a declaration that all the dues, all the fees have been settled and have been paid to the SEBI. Declaration come undertaking of the applicant and the acquirer, the person who shall have the control. So, acquirer is the ERP entity or the entity who will have the control over the organization. So that person will also have to give a duly stamped declaration come undertaking that there will be not any change in the board of directors till the approval is granted by the SEBI. So this application is made to the SEBI for the approval. Approval of what? Approval to have a change in the control of ERP. So meanwhile, you have applied to SEBI for the approval. You have to give, the acquirer have to give a declaration that till we receive the approval of SEBI, no change shall be made in the board of directors. Then, pursuant to the grant of prior approval by SEBI, the incumbent shall inform all its existing investors or clients about the proposed change. The ERP also need to inform its clients that we are going to have a control change in order to enable them to take informed decision regarding their continuance or otherwise with the new management. So whether your clients, whether the entities who are taking ESG ratings from the ERPs want to continue with you or not. The fit and proper person criteria, as specified in the SEBI intermediate regulation, is also to be followed. The prior approval, the prior approval which we are seeking from the SEBI, once granted, will remain valid for a period of 6 months from the date of such approval. You have applied to the SEBI for the prior approval to have a change in the control. Now, SEBI has given you the consent, the approval to have that change in your control in the board of directors. Then that approval will be valid for a period of 6 months. If the ERP has rated any product or issuer which falls in the ambit of another regulator. For example, if the ERP is giving ESG rating to such an entity which falls under the ambit of any other regulator, also the product or the security also falls under the ambit of any other regulator, not only the SEBI approval will be required to have a change in the control, will also have to have that approval from such other regulator or agency. Along with SEBI, we are also required to file an application with such a regulator. If the ERP has not handled any such product or issuer, then it shall provide a confirmation to that effect. So, whether you are falling under any other regulator apart from SEBI or not, you are required to inform the SEBI along with the application which you are giving to the SEBI in the very first place for the prior approval. To streamline the process of providing approval to the proposed change in control of an intermediary in matters which involve scheme or arrangement where NCLT involvement is there, the terms or provisions of the Companies Act will be applicable. So as soon as NCLT comes into picture, the provisions of Companies Act 2013 also come into play. The application seeking approval for the proposed change in the control shall be filed with the SEBI prior to filing the application with NCLT. So, for example, where there is a control change in which NCLT approval will also be required, so the first step will be to file an application to the SEBI and then we will file an application to the NCLT. Upon being satisfied with the compliance of the applicable regulatory requirements, an in principle approval will be granted by the SEBI. So, in case where the NCLT is involved, the approval will be known as in principle approval, which will be given by the SEBI. The validity of such in principle approval shall be 3 months from the date of issuance, within which the relevant application shall be made to the NCLT. So, one thing which we need to keep in our mind is that there are two timelines for the SEBI approval validity. One is 6 months, where NCLT is not involved and the approval has been given by the SEBI. Next, where the NCLT is involved, you need to have first SEBI in principle approval, which will be valid for a period of 3 months from the date of issuance, and then within those 3 months period validity, you need to file an application to NCLT. Now, as soon as you get the NCLT order, the intermediary shall submit an online application with the following documents to SEBI for the final approval. So, first you have the in principle approval, then you go to the NCLT, and when the NCLT approves, you again go to the SEBI for the final approval, where you will provide a copy of the NCLT order which approved the scheme. What is the approved scheme? You will also file a copy of that. Statement of explaining whether any modifications or changes were made in the proposed scheme and how the compliance is to be made with all the schemes and arrangements. So, we covered two aspects by now. One is the registration with the SEBI of the ERPs, and second aspect is when there is a change in the control, how we are going to report to the SEBI and how that change in control will come into picture. Next is the transfer of business by SEBI registered intermediaries to other intermediaries. SEBI has been receiving registration applications pursuant to transfer of business from one legal entity which has already been registered with the SEBI to another entity. So one entity becomes the transferor and the other entity becomes the transferee. So in this regard, when the transferee comes into picture, it needs to obtain a fresh certificate, a registration from the SEBI. And then after getting the fresh registration, then only it will be able to work as an ER. SEBI shall issue new registration to such transferee, and that registration number will be different from that of the transferors, irrespective whether the transferor continues to exist or ceases to exist after such transfer. In case of change in control, prior to the approval and fresh registration, prior approval and fresh registration shall be obtained. While granting fresh registration to same legal entity pursuant to change in control, same registration number shall be retained. Now, in any case, whether the transferor entity ceases to exist or the transferor uh, completes the transfer, its registration certificate will deemed to be surrendered. So now, in case when an entity has transferred its business to another entity and transferor is no longer into the picture and it has ceased to exist, then in such a case, the certificate of registration shall be surrendered. In case of complete transfer of business by the transferor, it shall again surrender its certificate of registration. In case of partial transfer, transfer, that means the transferor is also still a legal entity and operating, and the transferee is also operating. It can continue. The transferor can continue to hold the certificate of registration. Next is the surrender, cancellation, suspension of certificate of registration. So, uh, with the basic understanding that suspension and cancellation can be done by the SEBI, and surrender, you will make a request for surrender of certificate of registration. So while undergoing the process of either suspension or cancellation or surrender, we need to facilitate the orderly migration of the ESG ratings, the clients of the ERP. In order to facilitate orderly migration of ESG ratings pursuant to cancellation, suspension, or surrender of certificate of registration of an ERP to another SEBI registered ERP. Now, there are steps which are to be taken into consideration. On and from the date of order or request. Order can be the SEBI's order, and request can be made by the ERPs. On the date of submission of request for surrender of certificate to SEBI, the concerned ERP shall, first of all, they need to disclose that either there will be a surrender or the suspension or the cancellation of their certificate of registration on their website. It helps the stakeholders to know what is going on with the ERP, their clients to know that how much time they have with the entity to disclose prominently on its website the order or the request as the case may be, and communicate the same to the client within 15 days of the order or the request. Now, since they are undergoing the surrender, cancellation, or suspension, the ERPs are not allowed to take fresh clients. Allow its clients to, and now they are also going to allow their clients to withdraw any assignment which have been given to the ERPs. Facilitate orderly migration of the assignments. Continue to comply with the provisions of the CRA till date they are into existence, or till date they are holding the certificate of registration. Continue to cooperate with the SEBI and sharing such information as may be asked to them time to time, and take such other action including providing any records or documents which may be asked by the SEBI or as required under the CRA regulations. So as soon as the process of surrender, the acceptance comes by the SEBI, or when it is commencing the winding up process, it shall return the certificate of registration to SEBI. It will not represent itself as the ERP. It shall suspend undertaking any activity of ERP, and until it is wound up, it will cooperate with the SEBI Also, it will make the provisions for the liability which are incurred or are assumed by it that it can incur. So now the ERP undergoes the process of winding up. Until it is wound up, it will take such other action, providing any records or documents as may be asked by the SEBI. So now, when the case of suspension comes means that SEBI is suspending the certificate of registration. Now, suspend undertaking activity for such certificate of registration had been granted. Continue to cooperate with the SEBI. Make provisions again for the liability in case of cancellation of certificate of registration. Now, where the certificate of registration get cancelled, the ESG ratings provided by the ERP will be valid till the client withdraws the assignment. So, in case of cancellation of an certificate of registration, the ESG ratings which have already been provided by the ERP will remain valid, but that validity has a time period. It has a time period, a timeline. One, when the client, till the time the client withdraws and or migrates the assignment to ERP as specified, or the ERP which has already provided the ESG rating wounds up, whichever is earlier. So either the client has the option to withdraw the rating or to transfer such assignment to another ERP, whichever the earlier case may be. In that case, the cancellation of certificate takes place and that validity of the ESG rating comes to an end. In case of surrender, so when the ERP is voluntarily surrendering its registration, or when there is a transfer of business, as we earlier discussed the case, if an ERP wishes to surrender, it shall transfer wherever relevant its existing business or clients to another SEBI registered intermediary before it makes a request to SEBI for accepting the surrender of certificate of registration. So when the ERP already knows that it will make a request to the SEBI to surrender its certificate, it will take a step prior doing that. It will transfer all its assignments, all its client accounts to another SEBI registered ERP. If at the time of the request of surrender, ERP has any outstanding rating which falls again under the ambit of any other regulator, then you will also have to get an NOC from that regulator. That NOC will, after only obtaining that NOC, you will go to the SEBI along with the request for surrender of certificate. In cases of transfer of business or client's accounts to another registered intermediary, the client shall not be subjected to any additional cost. Because surrender is voluntary, you are helping the clients, you are helping the assignments, the clients to migrate from the ERP which is surrendering to the other ERP. No additional cost will be incurred by the clients. In case of suspension of certificate of registration, the ESG ratings assigned by the ERP, whose certificate of registration is suspended, shall not be valid during the period of suspension. Now, if the SEBI has suspended your certificate of registration and you have already provided the ESG ratings, so during that suspension period, the ESG ratings so provided by the ERPs will also remain suspended. Upon cancellation or surrender or suspension of certificate of registration of an ERP, the concerned ERP's services cannot be used by listed entities or issuers. So, whether the ERP is going under the process of surrendering or suspension or cancellation, the ERP services cannot be used by their clients, by the listed entities or issuers for compliance with various SEBI regulations which require ESG ratings from ERP registered with SEBI. So, when a reporting entity or when a organization needs to have an ESG rating in terms of compliance with a statute or with a law, then that entity cannot have ESG rating from such ERP who is undergoing the process of surrender or suspension or cancellation of certificate of registration. So, this was the first chapter where we understood the process of registering, from registering to transferring the businesses or having a change in the control, and then to the surrender, cancellation, and suspension of certificate. Coming on to the next chapter, which deals with the rating operations. How the rating is given, to whom the rating is given, what are the models, business models followed by the ERPs, what type of ratings are given, what are the methodologies used, what is the rationale behind giving a rating. So this chapter deals with these things. Now, the very first thing which this chapter deals with is the types of ESG ratings. We have all been talking about the ESG ratings, how why it is important, what is the need, how ERP came into picture, how ESG ratings help the investors to make the informed decisions. Now we have various types of ESG ratings. So ESG ratings can broadly be classified into core and non-core ESG ratings. So first, let us talk about the non-core ESG ratings. So non-core ESG ratings, as the name is suggesting that the data for the non-core ESG rating will not be assured by any third party, because you are not picking up the data from the BRSR core, that the assured report. You are picking up the data from a plain simple BRSR. So here the ratings will be ESG rating, the transition or Parivartan score. Also, one of the significant points which is to be noted for this master circular is that the term ESG rating or ESG score has been used interchangeably. So, under the types of ESG ratings, you have ESG rating as one, and then you have transition or Parivartan score. So, the term transition or Parivartan score is indicating towards the company's steps to attain the net zero goal. So, the transition phase which the companies are undergoing, where they are setting the targets for themselves to achieve net zero, and that transition phase, so for that transition phase the rating given is called transition or parivartan score, and then we have combined score. So to have an easy understanding, combined score is the ESG rating plus the transition score, but that does not mean that you are simply adding up the ratings. For example, I got ESG rating A, and in transition score I got a rating B. Now you're adding A plus B. No, you need to have a solid rationale that why a combined score is being reached. That will be the weighted combination of the ESG and the transition rating. There must be a logic behind it. So these are the three types of ESG ratings which fall under the non-core ESG rating. Now coming on to the core ESG rating. Again, the term core has been prefixed behind the ESG score, transition score, or the combined score. Okay. The core ESG rating, core transition score, core combined score. Here it is denoting that whatever data we are picking up to give a rating to an entity is based on the data which has already been assured by the independent assessor. So ESG rating as per the CRA regulations is marketed as an opinion about issuer or security regarding its ESG profile or characteristics or its exposure to the ESG risk, the governance risk, social risk, climatic or environmental risks, or impact on society, climate, and environment. So it is not always necessary that a rating which is provided by an ERP is to be termed as ESG rating. Any other rating which deals with the ESG aspect, which deals with its profile, the characteristics of an organization in terms of ESG, or its exposure to the risk, which the risk which is covering the ESG risks, that constitutes ESG rating. Then we understood that how the ESG rating has been divided into two parts: the core ESG rating and the non-core ESG rating. And ERP may provide additional ESG rating products subject to compliance with the relevant provisions of the CRA regulations. So apart from these, an ERP, if wants, can have any other additional rating also, but there must be a rationale behind it. There must be a methodology used behind it, and the factors taken into consideration must be reported as per the regulations. So, if any ESG rating product which is referred under the non-core ESG rating, and the ERP relies while providing the non-core ESG rating, you are providing the non-core ESG rating, but still the ERP relied upon the data which has been assured by third party, then that ERP is not required to have a rating which falls under the core rating. If any ESG rating products that is the non-core ESG rating. The ERP relies on third-party assured parameters. Then the ERP shall not be required to provide a separate ESG rating for the core rating, because while giving the non-core rating you already relied upon the data which is already assured by an independent assessor. So it is considered that you have already provided a core ESG rating. If an ERP incorporates transition assessment in its ESG rating or core ESG rating, then ERP shall not be required to separately offer a combined score or a core combined score. So combined score is what? The ESG rating and the Parivartan score or the transition score. But while giving the ESG rating only or the core ESG rating only, the ERP has already considered and taken into consideration the transition phase of the company, and it has given pointers and the reasoning behind such a transition phase, and it has taken into consideration how the transition phase is impacting, and that impact has been included in the ESG rating and the core ESG rating. Then ERP is not required to provide a separate combined score or core combined score. The ESG ratings, which we have discussed, we broadly categorized into core and non-core. Non-core rating product shall suitably incorporate the environmental, social, and governance aspects, because this is all about the ESG rating. So definitely it will consider into the ESG aspects, and then indicative list of these ESG parameters. Based on these parameters, you are reaching up to a total of ESG rating. So these parameters have already been defined and they are provided in the annexures annexed with the master circular provided by the SEBI. Now, another important aspect which ERP should take into consideration while providing a transition score is that you need not to be very absolute or strict while measuring the transition score for an organization. We have to keep in mind the conditions or the social conditions, economic conditions of an organization while giving the transition score. It is observed that various Indian companies may be rated on their current emission levels as they begin to align their strategies with the India's commitment of emission intensity reduction net zero by 2070. Now the organization are getting started. They are setting targets or goals for themselves. Now, at this very point, at this very juncture, when the companies are initially aligning themselves, they're aligning their strategies to have the net zero, we cannot measure or give the rating which is based on a very strict evaluation. Evaluating Indian corporates on an absolute yardstick without recognizing the efforts they make and results they achieve in transition may not lead to the appropriate incentives for transition finance. Hence, ESG rating providers shall provide two additional things. One is the ESG transition, that is the Parivartan score and the combined score. So, while giving the Parivartan score, we are measuring the velocity and investments in making transition to net zero goals. A combined score, as I earlier mentioned, is a combination of ESG and transition or Parivartan score. But this addition does not mean a simple addition, the mathematical addition. It refers that ERP shall be free to combine these two ESG ratings or two scores in such a way that it is consistent with the publicly disclosed rating methodology. So that the combination of the ESG rating or the Parivartan score is such that it is logical and it has a publicly disclosed rating methodology. Now, coming on to the core ESG ratings, it is similar to that of the non-core ratings, but the only part which we need to consider is that the observations are on the data which are verified by the third party. But there might be cases where the core ESG rating may contain additional commentary or observations on the data which is not verified, because core contains specific pointers, and on those pointers the data has been verified. But the organization may provide such data which is not assured by the third party. Apart from the core KPIs, core data, another data may also come into the picture. So in that case, the ERP need to comment upon that also. The ERP will need to disclose the rationale for the data which is not verified by a third party. This ensures that unverified data is not included in the core ESG rating, but at the same time, users of the core ESG ratings are made aware that unverified data was also there, based on which they take any action they deem appropriate. Further, a core combined score will also be there, same as was in the case of non-core ESG rating. Now, for to have a balanced, uniform, consistent rating, the SEBI has provided a rating scale of 0 to 100, where 100 represents the maximum score. For existing outstanding ESG ratings, the ERPs shall disclose new rating symbols and definitions on their website and update their rating list on their website. For various ESG rating products, the all the six ESG ratings which we have discussed earlier, ERP shall ensure use of a suitable nomenclature. So they are to be prefixed whether they are non-core ESG ratings or core ESG ratings, so that the user or the investor or the stakeholder who is using that ESG rating gets to know that how this ESG rating has been derived. So apart from providing the ESG rating, the other activities which ESG provider can do has been separately mentioned under the CRA regulations. So CRA regulations allow ERPs to undertake or offer ESG rating of any product or issuer as may be required by another financial sector regulator or authority, as may be specified by the SEBI under the guidelines of such regulator or authority. So, as we also earlier discussed, that there might be instances where the ERP has provided ESG rating to such issuer or to such securities which are governed by another regulator, another financial sector regulator. So, they were required to take permissions in case of surrendering or cancellation or registration. So, in the same way, the CRA regulations allows the ERP to give ESG ratings to such issuers or such securities where those are regulated by any other regulatory authority. A list has already been provided under the CRA. The ESG ratings undertaken by ERP under the guidelines of IFSCA shall be under the purview of IFSCA. So IFSC is International Financial Service Centers Authority. So when the ERP is undertaking is providing ESG rating under that regulator, so that regulator will have the full authority to observe the ESG rating provider. So any issue arising from those activities for the SEBI registered ERPs under IFSC shall be dealt by the IFSCA under the IFSCA Act. So IFSCA will be then responsible for dealing with the complaints, the enforcement actions, furnishing information to third parties, including statutory or judicial bodies in respect to services provided by the ERPs under IFSC. ERPs may also undertake research activities incidental to ESG rating, such as research for economy, environment, ecology, society, and social issues, industries, and companies. So, apart from providing the ESG ratings, the ESG rating provider can also undertake the research activities. Now, when we look into these research activities, we can uh, see that these research activities are somewhere connected to the ESG aspect, the economy, the environmental and the ecology, the society, and the social issues. So it is again pushing the ERPs into a direction of ESG only. They can do their research in that sector. Now there will be a client group level segregation for ESG ratings and or green debt certifications. So what is client group level segregation? Client group level segregation is ERP is having a client. Suppose a company is the client of a ERP. Now that company has another group companies. So we need to segregate that. That is known as client group level segregation. For the purpose of this provision, client group shall include the client company of ERP and all the group companies of such client of the ERP. For any client group, an ERP shall only offer any of the two services. Either it can provide you the ESG rating or it can provide you the green debt securities rating. Second, or second thing which it can do is audit the financial statements or provide you the assurance of sustainability disclosures. So an ERP For the client group companies, it can do any of the two things. One is providing the ESG rating or green debt security rating, or it can audit the financials or certify the sustainability disclosures. In case ERP wishes to migrate from offering ESG rating or green debt rating to audit services, then a cooling off period will be there, and that cooling off period will be 1 year. So we can understand this with the help of an example. Suppose ERP is providing ESG rating services to company A, and now it wants to provide audit services, the sustainability data assurance services to that same company, then the ERP will have to undergo through a cooling period of 1 year. Then only it can interchange its services. Now, coming on to the business models, which we also had a glimpse and discussed about the issuer pay model and subscriber pay model. So, when the subscriber pay model comes into picture, when the revenues of the from the ESG ratings are coming into the picture from the subscribers. Now, the subscribers are the persons who take informed decisions based on these ESG ratings, and these may include banks, insurance companies, pension funds, or the rating entity itself, rated entity itself. Now, issuer pay model is the business model where ARP derives its revenues from the ESG ratings from the rated entity in terms of a written contractual agreement. In the very beginning of the webinar, I mentioned that there are different compliances for the issuer pay model ERPs and for the subscriber pay ERPs who are working on those models. So for the issuer pay, it comes into picture that you have to have a contractual agreement between with the entity, with your client, which may contain the provisions as may be specified by the SEBI, and those provisions are relating to the fee structure, how the rating will be provided, what will be the methodology used. And in order to mitigate any conflict of interest, it is mandated that ERPs shall not follow a hybrid model. How a conflict can arise if the ERP is following a hybrid model? Because let's see, when the ERP is generating revenue from the issuer as well as from the subscriber, it creates a conflict of interest. The ESG rating gets manipulated. With which ESG rating will you try to have your decision of investment being made? Whether the ESG rating, which has generated revenue for the ERP from the issuer of that particular security, or the ESG rating which has been provided by the ERP from the subscriber point of view. So it creates a conflict of interest. That's why it has been strictly prohibited under the regulations. And at the very beginning, when the ERP gets registered with SEBI, they have to mention whether they will be performing on the issuer pay model or the subscriber pay model. Now, coming on to the rating process, ERP shall frame detailed guidelines and disclose the same on its website. So, while providing the ESG rating, ERPs have been mandated to disclose on their website the guidelines through which they are providing the ESG rating. What is the general nature of compensation arrangements with the rated entities? So, now what we are discussing is with the aspect of the uh, issuer pay and subscriber pay model, that how the ratings will be given. So general nature of compensation, policy request or review appeal by issuer against the rating being assigned to securities. So, in case where a particular ESG rating has been provided by the ERP to an to a entity, the entity can come and request for review or appeal for the rating provided by the ERP. Guidelines on what incorporates as the non-cooperation. So, non-cooperation is the concept for introduced for the agencies for the entities getting rated, which are getting the ESG rating. In that case, the ERP will have to follow an issuer pay business model. So, while undergoing the issuer pay business model, a non-cooperation will be there, because why? Your client is an issuer, or the person who is issuing the getting rated. So in that case, you will have to mention what constitutes the non-cooperation. Then there will be gift policy, confidentiality policy, policy for outsourcing the activities, FAQs on the rating, and how the conflict of interest will be managed. If there is any change in these processes of rating, then again the ERP needs to disclose the same on its website. Now, the ERP will also have a record of the ESG rating, and it will have a record of the important factors underlying the ESG rating and the sensitivity of ESG rating to such factors. That, for suppose, ERP has come to a rating, a particular rating, so it should have that what are the factors which the ERP took into consideration for achieving that ESG rating, and how much that ESG rating is sensitive to those factors. That if such factors fluctuate or vary, then how the ESG rating will be impacted. Summary of discussions with the clients and the copies of correspondences with the issuer will also be maintained. If quantitative model is a substantial component of the ESG rating, quantitative data has been used while providing the ESG rating, then the rationale for the material difference between the ESG rating implied by the model and the ESG rating actually assigned, that has to be given by the ERP. So when the ERP is using a quantitative data of an issuer, and there is a variance between the ESG rating which is getting arrived with the help of that quantitative data and what the ESG rating has been provided by the ERP actually, then that difference needs to be accounted for. The above records are to be maintained for a year of tenure of 5 years. In case ESG rating of listed entities, records to be maintained at all times. However, upon withdrawal of that ESG rating, it still has to be maintained for 5 years from the date of withdrawal. ESG rating of listed securities, records are to be maintained 5 years from the maturity of securities. So these are two ESG ratings. One is given for the listed entity, and the other one is given for the securities which are listed. So in case the listed entities withdraw the ESG rating, then also it has to be maintained for 5 years. And in case the securities get matured, then also it has to be maintained for a period of 5 years from the date of maturity. Now the ERP has provided you an ESG rating, but that ESG rating may fluctuate. It may fluctuate because of various factors. Today, when the ERP collected data from the entity, it have some other data. There might be some other processes going on in the organization, and after a period of 1 month or 2 months, there might be any controversy happening or any material event happening in the company, which can again lead to change in the ESG rating. So when such changes are occurring on a day-to-day basis, or the material events are happening at a very frequent rate, how the ERP is going to maintain the authenticity of the ESG rating provided. So for that, the ERP shall on annual basis undertake review of the decisions taken by in that year, which would alia include ESG ratings assigned by the ERP, including ratings assigned based on best available information in case of non-cooperation by the issuer, sharp changes in ratings. So these are the things which ERP has to keep in mind, that a material event has occurred within a company, and now the ESG rating will be impacted. So they have to take into consideration that impact, and then the ESG rating will again be modified. The ERP at all times shall observe high standards uh, and fairness in conduct of business, and any act or omission in contravention of the provisions of the code of conduct will violate the provisions of the SEBI Act and SEBI regulations. Now, monitoring and review of the ratings. As I just mentioned, that the ERP need to review and monitor the ESG ratings which it has provided on the ESG factors to ensure timely and accurate ESG ratings. Whenever there is any material event or development in the respect, then such material development shall include but not be restricted to publication of BRSR report or any penalty in environmental, social, or governance aspect. So, if the ESG rating not only gets impacted because of a negative event or a material event, it also gets impacted due to the publication of BRSR report also. ERP shall carry out a review of the ESG ratings upon the occurrence of the announcement or such material development or news, and immediately, but not later than 10 days from the occurrence of such event, it shall review the ESG rating. That means the SEBI is pushing the ERPs. The regulations want the ERPs to have a continuous track of the ESG ratings given by them, and they want the ERPs to review them on a continuous basis as soon as possible. But and the deadline is also being set for 10 days from the date of occurrence of such material event. Now coming on to the rating rationale. So the ESG provider has given a rating. Now there must be a rationale behind it. So for giving the rationale, there are various factors which are taken into consideration, and those factors need to be disclosed by the ESG rating providers. So, ESG rating providers generally follow either a subscription based business model or issue pay business model. Now, these two business models are separate and they have separate compliances. It is essential that ESG rating rationale to be articulated in detail to enable a stakeholder to assess the reasons behind the ESG rating assigned to it. So, therefore, in order to provide greater transparency in the ESG rating process, it is proposed that the ESG rating rationale must contain the following. At least these are the minimum disclosures which must be there in the ESG report or the ESG rating rationale report. The current ESG score, change in the rating score from the previous evaluation, last review date, summary of the key drivers, which will constitute both the qualitative data as well as the quantitative data, the pillars, the ESG scores, basically the key drivers for ESG, their weighted average in the total ESG score or ESG rating, brief explanation of rating intent to clarify if it represents unmanaged risk, performance against risk, or impact, etc. In case this is available in a methodology document, cross linking of the relevant document would suffice. And then lastly, there must be a summary of or link to the methodology used. So these are the minimum requirements which must be there in the ESG rating report or in the scorecard that you are highlighting these points, and a summary to the methodology used for arriving at that ESG rating must also be there. So, in case if the ERP, so that was the case when the ERP was following a issuer pay model. But when the ERP is following a subscriber pay model, then they must share the detailed rationales. Instead of providing a summary highlight, they must provide the detailed rationales only with the subscribers, and that must not be disclosed on their website. May not. So it is upon the discretion of the ERP whether they will be disclosing the detailed a part of the ESG reporting, or they'll be not disclosing the detailed part on their website, but they need to may share the detailed rating rationale to the subscribers. However, ERPs following the subscriber pay business model shall disclose the ESG ratings assigned on their website in the following format. So, in the format which is to be provided on the website, which is the minimum requirement, it must contain the name of the rated issuer or security. That means the name of the client or the security for which they are providing the ESG rating. They must disclose the sector in which that entity is working, the ESG rating given to it, and the date of rating. So these are the minimum disclosures which must be there on the website of the ERP when they are working on the subscriber pay model. Now coming on to the disclosure of rating sensitivities in the rating rationale. We discussed the rating sensitivity. So sensitivity comes from the factors on which the ESG rating has been provided. So whenever there is a change or disruption in those factors, we need to take into account the sensitivity of ESG rating to those factors. The disclosure of factors to which the rating is sensitive is critical for the end users to understand the factors that would have the potential to impact the ESG profile of the entity. For example, there are 10 factors on which the ESG rating is based. Now, out of those 10 factors, three are the most potential factors which will have an impact on the ESG profile of the entity. Now, whenever there is a deviation or disruption or variance in those factors, or there is an impact on those factors, definitely an impact can be seen on the ESG rating. So, this factor sheet, this disclosure of the factors and the sensitivity of ESG rating helps the investors or to have a more informed decision, investment decision to take for the whether to invest in the entity or not, whether it is the correct time or not to invest or to take out their funds. Accordingly, in order to improve transparency, the ERP shall have a specific section on rating sensitivities in the rating rationale, which shall explain the broad level of environmental and or social and or governance aspect. So again, in the rating rationale, we are including the rating sensitivity factors. Now, when the ERP specifically follows issuer pay model, then there has to be a rating agreement between the issuer and the ERP. So that contractual agreement, that rating agreement, will consist of the provisions with regard to the rights and liabilities of each party. What will be the rights and liabilities of the ERP? What will be the rights and liabilities of the entity which will have the ESG rating? What will be the fees charged? How the client is supposed to cooperate? What are the circumstances when non-cooperation will be instigated? And if the ERP shall also disclose to the client the ESG rating assigned to the party or to its securities through regular methods of dissemination. The client also agrees to disclose the history and status of previous rating relation with the earlier ERPs. So it is a contract which establishes the relationship between the ERP and the entity who is seeking the ESG rating, the client for the ERP. The client also agrees to provide the information sought by the ERPs immediately, but not later than 7 days from the date of seeking such information by the ERP. So this particular clause in the contractual agreement decides and binds the client to timely provide the information asked by the ERP. So it is providing a maximum time gap of 7 days from the day the information was sought by the ERP. The ERP following issuer pay business model shall refrain from giving indicative ratings without having a written agreement in place. In case such indicative ratings are provided by the ERP, it shall be considered as aiding and abetting the issuer in suppression of material information by the ERP, which will again be a contravention of the code of conduct of ERPs and which again will lead to the violation of the SEBI Act and other SEBI regulations. So when the this means that the ERP, while operating on the issuer pay model, needs to have a contractual agreement with its client, and without that agreement, it cannot provide the indicative ratings. And if it is providing the indicative ratings to such entity, then it shall be deemed as the violation of the SEBI Act and other SEBI regulations, and also the code of conduct which has been recognized for the ERPs. Now, how we will define or how we will come to the conclusion that whether the issuer is not cooperative. So, if the rated issuer or the issuer whose securities are rated by the ERP refuses to cooperate with the ERP regarding the review of ESG rating, despite being under the contractual obligation to do so, the EPR shall review the ESG rating on the basis of best available information. As we earlier discussed, that ESG rating has to be reviewed by the ERPs on a regular basis whenever a material event occurs. It has to be reviewed. Now, for that review, additional information, additional data is required by the ERPs. So, whenever the ERPs ask the data, it is the obligation, the contractual obligation of the entities to provide the data. If they are not providing that data, then the review of the ESG rating will never be stopped. It will be continued, but it will be continued on the basis of the best available information. In case of non-cooperation by the issuer in line with the existing regulations, the ERP shall continue to review the ESG rating on an ongoing basis throughout the rating's lifetime on the basis of best available information. And such disclosures will also be made in the ESG rating report that the rating has been reviewed but has always been reviewed on the basis of the best available information because the entity was under non-cooperation. The ERP will also have a very detailed policy with regard to such non-cooperation. And when the ESG rating has been reviewed on the basis of best available information, again a policy must be there with the ERPs, which will define the criteria or methodology in respect of assessing the risk of non-availability of information from the issuers, including non-cooperative issuers. ERP shall also formulate a policy of on minimum or indicative information requirement in terms of various sectors or types of ratings and disclose it on their website. In case of non cooperation by the issuer, the ESG rating symbol shall be accompanied by the suffix issuer not cooperating. That means the reader or the user of that ESG rating report knows that this rating has been arrived under the circumstances where the issuer is not cooperating and the data has not been properly given to the ERP, and the EH rating has been derived on the best available information. Now, information to be disclosed through rating rationale. So, while giving the ESG report, we have to disclose the rationale behind it. So, what will be the things which will be uh, constituting the rationale? So, you have to disclose the date of the rating rationale, the details of security or the entity which is being rated, the rating action. You have to give the factors on which the rating is based, a brief write up on the non cooperation, rating history for the last 3 years, name and contact details of the rating analyst. There can also be rating withdrawals, and rating withdrawals, as we earlier studied, discussed under the concept of surrender, cancellation, suspension of the certificates also. A rating may also be revoked on the basis when the maturity of the security has been matured, or the 75% of the bond holders give their consent to withdraw the rating. So there are various ways of withdrawing the ratings. That ERP shall not withdraw an ESG rating except in cases where the rated issuer or the issuer whose security is rated is wound up, merged, or amalgamated with another company, or except in cases as may be specified from by SEBI from time to time. So if the ERP is following a subscriber pay model, the ERP may withdraw a rating that when there are no subscribers for the rating as on the date of withdrawal. So when the ERP is working on the subscriber pay model, it can withdraw its rating. However, where the rated entity or instrument is a part of rating package, for example Nifty 50, which it continues to have its subscribers, then such rating may not be withdrawn. So when it comes to rating package, whenever there is also even a one subscriber, you cannot withdraw such rating. Once withdrawn, the ERP shall ensure that such withdrawn rating is not made available to any subscriber in future. The ERP may withdraw the rating for an issuer or rated entity in case of non-availability of BRSR report also, because it is also considered a material event that BRSR report is not available. In case when the ERPs are following an issuer pay model, as I just mentioned, the ERP may withdraw the rating subject to the ERP having rated security continuously for 3 years, or 50% of the tenure of the security is over, whichever is higher, and having received NOC from 75% of bondholders by value. So, issuers can always have a request for review or appeal to the ERPs. Governance norms for ERPs is they have a board. The board the board will have a chairman. A chairman can be the executive director or the non-executive director. In case the chairman of the board is the non-executive director, then then the board will have 1/3 of the independent directors. And if in case the chairman is an executive director, then half of the board of directors will be constituted by the independent directors. Then the ERP will have ESG subcommittee and nomination and remuneration committee. Now, this clause to have ESG subcommittee has been implemented with immediate effect for the ERPs under the first category, and it has been deferred for the ERPs operating under the second category. Then the ERPs will also have chief rating officers, which will directly report to that ESG subcommittee, and the nomination and remuneration committee shall be chaired by an independent director. So, the deferment of the requirement of the ESG subcommittee was considered because of the challenges faced by the ERPs operating under the category 2. Now, dealing with the conflict of interest, an ERP shall formulate policies and internal codes for dealing with the conflict. And ERP shall always ensure that the persons who are working for providing the ESG rating will not have any kind of relationship with the business development or negotiating the fees with the issuer, or with the entity whose securities are to be rated. So that there has to be a separation within the ERP. that the business is taken care of by other persons, and the person giving the ESG rating is separate and is not involved in the process of promoting or developing the business.
Ruchi, maybe the slide is not moving, or maybe you can share the notification.
Okay. So coming on to the periodic disclosures. So periodic disclosures, and ERP shall make all the disclosures stipulated on the website. And in case of listed entities or securities, the ERP shall also make disclosures to the stock exchanges as specified by the CRA regulations. And yeah, an ERP can make additional disclosures other than those which are provided under the CRA regulations or circulars. Disclosures by ERPs will be on annual basis, and disclosures shall be made within the 30 days from the end of the each financial year, that is end of March. So within 30 days from there, they have to make the ERP will have to make the disclosures. So the disclosures will be on the ESG rating, the history, and the movement. A rating summary sheet will also be there, which will present a snapshot of the rating actions carried out during the year, and which shall be uploaded by the ERPs on their website. Details of new ESG ratings assigned during the last year, how the what was the movement in all those ESG ratings, the history of ESG rating of all outstanding listed entities and their securities. Disclosure of average rating transition rates, that what is the transition rates between the ESG ratings already existing. ERP shall publish their average 1 year rating transition rate over a 3 year period on their respective websites, which shall be calculated as the weighted average of transitions for each rating category across all static pools in the 3 year period. Now, there are various pools, static pools, which the ESG ratings outstanding for each category at the beginning of the financial year. However, it shall exclude ratings that have been withdrawn or ratings for non-cooperative issuers if applicable during the financial year. Then comes the transition rate. The transition rate is the number of movements or transitions from each rating category to another as at the end of the financial year as a percentage of total number of ratings in the static pool. ERPs should also disclose two additional and separate rating transition matrices limited to ESG ratings of entities or securities that are listed or proposed to be listed on a recognized stock exchange using the definition of static pool. Now, again, the static pool will be now there will be two static pools with the help of which we will make the rating matrices outstanding for each category at the beginning of the financial year, and outstanding ratings outstanding for each category at the beginning of the financial year. It shall include ratings that have been withdrawn or ratings for non-cooperative issuers as applicable. So there will be two separate rating transition matrices. Now, for the income part, the ERP should also disclose the income, and ERP should disclose the general nature of its compensation arrangements with the issuers, its total receipt from the ESG rating services and non-ESG rating services, issuer-wise percentage, share of non-ESG rating income of the ERP, names of the rated issuers who, along with their associates, contribute 10% or more of the total revenue of the ERP. Now, then there comes the continuous disclosures. The continuous disclosures will be the rating history, the rating rationales, rating reports, the methodology of rating, disclosure in case of delay in periodic review. So, whenever there is a delay in the periodic review, the in the ERP also needs to disclose the same on its website. Disclosure of guidelines for dealing with the conflict of interest will be there. An ERP shall also disclose its shareholding pattern as prescribed by the stock exchanges for a listed company as per SEBI LODR regulations. Then coming on to the next chapter, which is internal audit. So internal audit has was already been there in the CRA regulations. and it is to be conducted on a yearly basis. The internal audit of ERPs can be carried out by chartered accountants, company secretaries, or CMAs who are in practice and who do not have any conflict of interest with the ERP. So, while performing an internal audit of ERP, the major aspect which the auditor will have to cover is the operations and procedures, including the investor grievance redressal mechanism, compliances with the requirements stipulated under the SEBI Act, rules and regulations made thereunder. The audit report will state the methodology adopted, deficiencies observed, and consideration of responses of the management on the deficiencies, management of the ERPs. The report shall also include a summary of operations and of the audit, covering the size of the operation, number of transactions audited, the number of instances where violations or deficiencies or deviations were observed. So basically, the internal audit which has to be carried out for an ERP will focus on the operational part, the part how the ERP is carrying out its business operation, how the ERP is providing the ESG ratings, what is the internal policy, how they are giving the disclosures, whether they are following the statutory requirements or compliances, whether they are maintaining their website, whether the ESG rating reports provided are as per the master circular or the any other law, the CRA regulations, and the adequacy of their infrastructure. The report shall comment on the adequacy of systems adopted by ERP for compliance with requirements of regulations and guidelines issued by SEBI and investor grievances redressal. Again, for the category 2 ERPs, because they faced the challenges in the initial years, this internal audit concept has been deferred to April 29 April 2027. So again, the internal audit right now is valid. Is the concept is in force for the category 1 ERPs. Requirements relating to internal audit of ERPs, the auditor need to be there are the eligibility criteria for auditors, and the auditor firm shall have a minimum experience of 3 years in the financial sector. The internal auditor of ERP, the internal auditor of the ERP shall declare the firm has not been employed by any other ERP for services for any other services in the past 2 years, and the partners of the firm do not have any association with any other ERP. The audit team must be composed of at least a chartered accountant, which can be an ACA or FCA, or a cost accountant, ACMA or FCMA, and a certified CISA or DISA or DISSA. Now, then there will be a rotation of internal auditor. An auditor shall be appointed for a maximum term of 5 years with a cooling period of 2 years. So the scope of internal audit will be whether the ERP maintains a minimum net worth or not, whether the targets which they have mentioned or the projections they have submitted to SEBI during its registration application are met or not. ERP and its employees who are associated directly or indirectly with the rating business have complied with the regulations or not. Have they been following the non-conflict measures properly or not? Has ERP defined the processes for operations that have been followed during the rating exercise? Policy in respect of non-cooperation needs to be examined by the internal auditor. Review of ratings has been carried out as per the policy review policy of the ERP. And then there must be the auditor should also cover the adherence to the prescribed methodology for calculation of transition rates. The action on the internal audit report will be the ERP shall receive the report of the internal audit within 2 months from the end of the year. Upon receipt of the internal audit report, the compliance officer of the ERP shall provide detailed comments, and the final action will be taken care of and shall be submitted to SEBI within 2 months from the date of receipt of internal audit report, or 1 month from the date of board meeting of the ERP, whichever is later. So the format in which the internal audit report will be submitted to the SEBI is there must be the observations by the auditors, then there must be the remarks of the compliance officer of ERP, then comes the comments of the board of ERP, and the corrective actions taken based on the observations taken out by the internal auditor. Then for the fifth chapter, that is the miscellaneous one, There have to be a designated email ID for regulatory communications with the SEBI. So ERP must have a designated non-personal email ID. The details submitted to SEBI must be in XBRL template. Then there must be information regarding the grievance redressal mechanism, that how the grievances are redressed whenever they come to the ERPs. Guidelines on outsourcing the activities by ERPs. Now, ERPs are also permitted to outsource their activities, but outsourcing may be defined as the use of one or more than one third party, either within or outside the group, by a registered ERP to perform the activities associated with services which the ERP offers. The principle for outsourcing by ERPs have been framed, and they are also present in the Master Circular. The SEBI registered ERPs desirous of outsourcing their activities shall not, however, outsource their core business activities and compliance functions. The SEBI registered ERPs shall be responsible for reporting any suspicious transactions, reports to FIU or any other competent authority in respect of activities carried out by the third parties. Then there is general guidelines. Then there are general guidelines dealing with the conflict of interest of ERPs and their associated persons in securities market. Then comes the standardization of industry classification. The Market Data Advisory Committee, MDAC, a standing committee constituted by SEBI, comprising of representatives from stock exchanges, depositories, and other market participants, examined the existing industry classification structures across sectors and developed a harmonized four-level industry classification framework. The four levels are the broad sectors, industry groups, sub-industries, and activities. Now, as the standardized framework will help bring about the uniformity in the classification being used across sectors and securities market, ERPs are advised to use the standardized industry classification published by recognized stock exchange for the purpose of rating exercise, peer benchmarking, research activities, including research for economy, industries, and companies, etc. Now, then there will be the firewall between the ERPs and their affiliates. So the ERP must maintain a board approval firewall policy ensuring separation from group businesses. Such policy and revisions thereto shall be ratified by the board of directors. That means the firewall policy must be board approved. And the policy will inter alia cover nature and extent of sharing infrastructure, offices, employees, or resources, if any, between the ERP and the non-ERP entity, including specification of whether such arrangement is temporary, measures taken by ERP to ensure the independence of its ESG rating process in view of the above arrangement in the non-ERP entity, guidance to employees on sharing information or resources between the ERP and the non-ERP entity. An ERP shall disclose on its website details of the common directors of chief executive officers or MDs between the ERP and non-ERP entity. The websites of SEBI registered ERPs and the non-ERP entities shall be separate. The ERP's website may contain hyperlinks to the separate websites of the non-ERP entities. So this was all about the master circular data, which has been provided by the SEBI in the month of July. And what we can take away from this master circular is that now the SEBI has formalized a full-fledged regulatory framework for ESG rating providers, and they are supposed to be in compliance with the credit rating regulations. Master circular. Rating methodology must be transparent. So, this master circular has an impact not only on the ESG rating providers but also on the ESG users. The users will be impacted in a way that they know that the ESG rating, which are now being provided by the ESG rating providers, is provided with the help of a data which is verified, or they have a rationale behind it. They can have the ESG rating report. The master circular data strengthens the reliability of the ESG ratings. and clearer timelines for the BRSR based reviews have been there. Whenever there is an major material event happening, then it will be the responsibility of the ESG rating provider to review that and to change the BRSR rating. Companies will have to make the timely disclosures whenever the ERP ask for the information. It is 7 days timeline. The companies will have to provide that data, ensure the availability of assured data. They will have to manage the controversies, and non-cooperation by the entities will also be tagged, and the user of the ESG rating will come to know that whether this ESG rating has been provided on the data provided by the company or on the best available information base. So overall, ESG performance management becomes an integrated compliance and risk and investor relations priority rather than a voluntarily sustainability exercises. Now, for coming to towards the ESG rating providers, this circular brings more clarity and accountability on their part. The processes have to be audited. They have to give the detailed versions of the methodologies, the rationale used. They have to be operationally disciplined in terms of their the procedures for non-conflict. Now there is also the regulatory clarity, that what are the regular statutes which are required to be followed, what are the compliances which are to be followed. Now, since this July 2025 master circular has superseded all other previous master circulars, then it becomes easier for the ESG rating providers to follow a particular master circular and the CRA regulations and the SEBI regulations. ERP have also will be pushed to strengthen their rating methodologies, surveillance systems, data governance practices, and with detailed responsibilities now codified for both SEBI and IFSCA jurisdictions, and with structured review timelines for 10-day events and 45-day in case of BRSR. So 10-day event is the material event happens on a particular day. Then within 10 days you have to review, and 45 days timeline has been allowed in case the BRSR report has not been put up, or if it has been put up, then it has been provided with a 45-day timeline where the ESG rating provider will again review its ESG rating. ERPs play a more critical role in improving market trust, enabling consistent ESG assessments, and supporting investors and issuers in navigating the evolving sustainability ecosystem. So if you have any questions, this is from my side. I have tried my best to cover the whole master circular so that we can have a basic understanding and knowledge about the how ERPs are supposed to work, how they are going to register themselves, how, and the major chunk under the master circular data is with regard to the rating, how the rating is to be given, what are the disclosures with regard to the ratings, how the ratings have to be reviewed, how ERP will work on a single model, whether it can be issuer pay or subscriber pay, and what will be the disclosures and compliances with each of the models, how internal audit is to be carried out, how the ERPs can have contractual obligations with the entities, and how they are responsible for providing ESG ratings, different types of ESG ratings, and how they have to review their ESG ratings. So this is all about the master circular data for July 2025.
Thank you so much, Ruchi, for the nice presentation. There are few questions which I wanted to take up here right now. So, one of that question is that under the new circular, how does SEBI plan to monitor whether ERP maintain a genuine separation of rating and the consulting activities? So, what is your view in terms of that these ERPs probably can have a mechanism to have a separation of both the activities where they are allowed to have under the same umbrella?
As we discussed in the master circular, that there are provisions, there are activities which an ERP can do apart from providing the ESG rating, and it can have a separate the distinction between the activities. And if they want to interchange their activities, there have to be a cooling period of 1 year with the same entity, and then they can reverse or interchange their activity.
One more query, and it's actually a genuine one. Like, since the core ratings are based on only on the assured BRSR core data, so what do you expect in terms of companies to shift from voluntarily sustainability report to assurance reports? So I'm sure the companies are now more focused to have more BRSR core assurance rather than the voluntarily assurance, so that they can have a core rating, because otherwise I don't think so that ERP will be able to give them the core rating. What is your view on that part?
So since BRSR is already mandatory for top 1,000 listed entities, we'll have soon the assurance part mandatory for all the organizations by 26-27. Then the ERPs will have to will be able to get the assured data, and then they can provide the core ESG ratings, the core ESG rating, the core combined rating, or the core transition rating. And also, if in any case, whether if when the ERPs working on the issuer pay model, and they are having the entities which are under the non-cooperation, so they can always put the tag and review the ESG rating, and let the users know that this rating is based on the best available information. And there might be times when the organization is doing a voluntary basis BRSR, the data might not be assured, but in that case, the ERPs can again ask for the data, and they can verify the data themselves. Also, it becomes a part of their ESG rating report, that they have to give the factors, the methodologies, the rationale behind it. So yes, also for since in India the companies are right now in the transition phase, they are aligning themselves with the SDGs. Slowly the data will be assured, and the core ratings will be aligned, and ESG rating can have more accountability.
Last question, that does the shift to the uniform scoring model, that was 0 to 100, to improve the comparability, do you think that it is for the better presentation, or maybe it can create a forced standardization issue?
So earlier, when it was not in the master circular, the ratings were given by the ERPs on their own, with their own discretions, with their own factors. Now, but having that 0 to 100 scale makes brings a uniformity, and this uniformity not only helps to have a better presentation, but it the major achievement of this uniformity is that the ratings can be compared not only within the sector the entity is operating, but along the sectors and industries. So it helps and it carries out a bigger task of having the comparability between the ESG ratings provided. So that scale of 0 to 100 is a very good initiative to have the uniformity and standardization.
Thank you. So these were the questions, and I think now, if you allow us, that we can conclude the session.
Sure, please.
Yeah. So, good evening, everyone. First of all, thank you so much to be, present on during the session. And on behalf of the Sustainability Reporting Standard Board of ICAI, I, Harsha Ramdani, extend my heartfelt gratitude to all the participants who has joined us today for the, very insightful session on the Decoding SEBI's Master Circular on ESG rating provider. This is actually a very important topic for all of us, and by seeing the active engagements and the keen interest from the participants, I understand this is the success of this webinar. And a special thank you to our distinguished speaker, Ms. Ruchi Singh, for delivering an insightful and the very active presentation on the critical aspect of SEBI's regulatory framework for ESG rating providers. What I can observe throughout the session, that her deep knowledge and the clear articulation on the requirement rating relating to the transparency, the standardization of the rating methodology, conflict of interest management, data reliability, disclosure obligation. I think we have discussed everything under the SEBI Master Circular provided to us. So, I think today's discussion underscores the importance of the regulatory compliances and the method that we need, ERP needs to follow it, auditability of the ratings, the stakeholders accountability in the ESG rating ecosystem. Further, I would say that it also, highlighted how the SEBI initiatives are promoting the consistency, also encouraging the companies to have a responsible reporting and strengthen the investor trust in the ESG evaluation. So, once again, thank you so much, everyone, and I extend my gratitude to all the attendees for the active participation, thoughtful engagements, and your enthusiasm for the further strengthen on the ESG reporting and assurance practice in India. Further, I would also like to invite you all to join us in the upcoming sessions where we as a SRSB are continually trying to have sessions on the emerging frameworks, sustainability reporting advancements, regulatory development, and the best practices under around the sustainability ecosystem. Once again, thank you so much to all the participants, and we look forward to continue collaboration and the meaningful knowledge exchange with all of us. Thank you.
Tech support, go offline. Okay.